Have you ever noticed how your brand new iPhone loses value the moment you buy it? Or that car that you spent millions of rupees buying, the moment you drive it out of the car dealership, it suddenly loses all of its value? That is what you call as depreciation. And in business, you don't just notice it. You measure it, you record it, and you use it to make certain business decisions. In today's class, we will be talking more about what depreciation is, and if this is something that you are interested to know more about, please do stay tuned. What is depreciation? Depreciation, the book defines depreciation as the systematic allocation of the cost of an asset over its useful lifetime. Now let me start recording this, right? Looking at the definition of what depreciation is, we said it is the systematic allocation. It is the systematic allocation of the cost of an asset over its economic useful lifetime. Now there are these you can consider as the three main components in this entire definition, right? What do you mean as the systematic allocation? Under the systematic allocation, we are referring to something called as the matching principle. What does the matching principle say? The matching principle requires any revenues to be matched against the expenses which helped them be generated. What do we mean by this? If you have an X amount of revenue that you've earned in the current year, and you have a Y number of expenses that you've incurred to generate these revenues, then those should be matched to each other for you to be able to calculate your profit. That is simply what the matching concept is. Which brings us to this example. So let's say you have a van that costs, let's say it costs you rupees 1 million, right? It costs you rupees 1 million and you're hoping, so let's say this is a delivery vehicle. It's a delivery vehicle and you're hoping to use this delivery vehicle over, let's say, a 10-year useful life, right? So you're hoping to use this for 10 years. So 10 years becomes your useful economic lifetime of the asset. And you are not planning to sell this for any price, right? Because you are using it for 10 years and it's a delivery vehicle, so there's going to be a lot of wear and tear. So it's highly unlikely that you will be able to, demand a good price for it at the end of 10 years. So therefore, let's say there is no residual value. No residual value, right? So what do we mean by residual value? Residual value is the price at which you hope to get rid of this asset. So, right? So at the end of the useful life of this asset, if there's an X amount at which you are hoping to sell this asset for, that is your residual value. And this is also called as the scrap value of an asset, right? So let's say this asset has zero residual value. It has zero scrap value. So how you calculate your depreciation in this scenario is depreciation has a formula, right? Depreciation has a formula. You take the cost of the asset minus the residual value and you divide it by the useful economic lifetime of the asset, right? So in this particular scenario, we have 1 million, which is the cost of the asset, minus 0 because we have 0 residual value, and you divide it by 10 years, which is the useful economic lifetime, which brings us to 100,000 depreciation per year. This is just a shortened form for depreciation. Feel free to write the full word. So that is what you call as depreciation, and this is how you calculate depreciation. But is this how you calculate all types of depreciation? Not really. This is simply how you calculate straight line depreciation, right? And when you calculate depreciation this way, you will notice that the amount of depreciation that you charge to the profit and loss account, or the depreciation that you take as an expense to your business, stays the same throughout the lifetime of the asset. For each of the 10 years, your depreciation will remain consistent. It will remain at 100,000. All right. I'll get back to why I emphasized on that. So we spoke about systematic allocation and we discussed about the matching principle, right? We spoke about the systematic allocation and we spoke about the matching principle. And we mentioned that the matching principle is about revenues that need to be matched against any expenses that help to generate those revenues. So if I go back to this delivery vehicle, right? This delivery vehicle has helped me generate income for 10 years. So if I were to expense this 1 million directly in year one itself, that's a violation of the matching principle. Why? Because I will be using this delivery vehicle over the next 9 years also. So I'll be using this delivery vehicle over 10 years in total, which is why I need to break down this cost for 10 years and expense it accordingly so that every year that I'm using this delivery vehicle to generate revenues, I will be able to expense it accordingly. That is why that is what is a systematic allocation, right? And we are allocating the cost of the asset over its economic useful lifetime. Why bother recording depreciation? Reason number one, it helps keep financial statements realistic. What do we mean by this? If you do not record depreciation, you are recognizing assets in your financial statements at their historical value and you are not depreciating them. You don't account for the fact that these assets are not worth the same as they were once. And as a result of that, you are showing your business to be much more richer than it actually is. For example, if you bought a vehicle, right? If you bought a vehicle worth 1 million 2 years ago, and according to our example, if the asset has a depreciation of 100,000 every year, 2 years later, the value of that vehicle should actually be 800,000. So where you should show that you have an asset worth only 800,000, if you show that you have an asset if you actually show that you have an asset that's worth 1 million, that's actually wrong, right? It shows that you are showing a picture where you are richer than you actually are. That is why depreciation is important, because it helps financial statements be kept realistic. And as a byproduct of that, we come to our second benefit, which is that it helps show real profits. What do we mean by this? You are taking the option of taking that 1 million and not recording it as an expenditure in year one, but instead you are going to record this as an expenditure over a number of years. So had you recorded 1 million as an expenditure in year one, your profit would have been considerably lower than it actually should have been. For example, let's say in year one, you ended up you had a profit, you had revenues of 1 million and you recorded the entire cost of the vehicle in year one itself. You have zero profit. But instead what you chose to do is you had revenues of 1 million and you chose to record only 100,000 as an expenditure. Now you have a profit of 900K. This is actually realistic. Why? Because this cost of 1 million is not a one-off cost. It's actually a cost that you will be benefiting from over a number of years, over 10 years. And the third benefit, it helps planning with taxes. What do we mean by this? This basically refers to the fact that depreciation is one of those expenses that is considered to be tax deductible, which means that the government recognizes it as an expenditure and helps you to deduct it from your revenues, as a result of which your profit will be lower, and as a result of which you will be able to pay lower income taxes on your revenues, on your profits. How do we record depreciation, right? Depreciation in itself is an expense. Depreciation in itself is an expense. We know when expenses are increasing, we record it on the debit side, and when expenses are reducing, we record it on the credit side. And as a result of that, because depreciation is considered as an expense, when depreciation expense is increasing, we record it on the debit side, and when depreciation expense is reducing, we record it on the credit side. But where does the other side of the double entry go to? The other side of the double entry goes to this account that we call as the accumulated depreciation account. The accumulated depreciation account. The accumulated depreciation account works like a liability account, and this is actually a balance sheet account, right? It's a balance sheet account. And why did I say it works like a liability account? Because the accumulated depreciation has a credit balance. Why does it have a credit balance? I mean, depreciation is related to assets, right? So why do we have this balance sheet account that has a credit balance? The reason is because accumulated depreciation in the balance sheet or in the statement of financial position, it needs to settle off against the asset accounts. So the asset has a debit balance, right? And if something needs to be set off against the balance in the asset account, it needs to be a credit balance. It cannot be a debit balance. If it's a debit balance, it will just add on to the asset value. So that is why accumulated depreciation takes on a credit form. So you debit the depreciation expense account and you credit the accumulated depreciation account, right? So every year you charge depreciation expense, you debit the depreciation expense account and you credit the accumulated depreciation account. As a result of which, over the years, your accumulated depreciation account will continue to build up, right? So let's say, let's go back to our previous example, right? Where we have an asset worth 1 million and we are charging an annual depreciation of 100,000. So in year one, you will record 100K. In year 2, you will record another 100K. In year 3, you will record another 100K, and so on and so forth until year 10, where you record 100K. So that means over the years, your accumulated depreciation will have built up a total value of 1 million, which will be the same value in your vehicle account, in your vehicle asset account. You will have a debit balance of 1 million, which is what you recorded when you initially purchased the asset. So in the statement of financial position now, you will be able to settle off both of them, which means your asset now is worth 0. So that is how you record depreciation. That is the double entry for depreciation. In terms of the calculation that we discussed, I initially mentioned that this is purely the straight line depreciation method. But there is also another way of how you can calculate depreciation, and that is what we call as the reducing balance method. Now, the reducing balance method, unlike the straight line depreciation method, on a year-on-year basis or on a periodic basis, the amount of depreciation that is expensed will keep changing. Why is that? Because of how the formula works. Reducing balance is not something that we will be discussing in this video today, but what you need to keep in mind is that the reducing balance method of depreciation is best fit for technological products because of how fast technology is advancing. So it really does make sense for reducing balance to be applied for such assets, whereas for assets like a building, for instance, or even a vehicle, it really won't make a lot of sense. Unless it's an electric vehicle, one could make an argument, but for assets like buildings, straight line depreciation is most often the most appropriate way of going about it. And at the same time, when we speak about depreciation, we also need to keep in mind that the reason why something needs to be depreciated is because it loses value over time, right? And there are certain exceptions to this. And if I ask you what are those exceptions, I think one common exception that should come to everybody's mind, or probably the only exception that should come to everybody's mind, is real estate, land. Land does not lose value, and as a result of that, in accounting, we do not depreciate land. Why? Because land is a scarce resource. As you learn more about economics, you will learn about what scarce resources are. You cannot build new land. You cannot build new land. You only have the same amount of land on this earth that you had 100,000 years ago, probably even lesser now. So therefore, the value of land will only keep increasing, and as a result of that, land is not an asset that we depreciate. So depreciation isn't just an accounting trick, it's a reflection of reality. Everything except land loses value over time. If you found this video useful, please make sure that you share it with anybody who you think might also find it useful. Like it, subscribe it, because it helps these videos reach to more people like you. And if you have any feedback, the good and the bad, we are all ears. Please make sure that you leave a comment sharing your feedback. Thank you so much. And until we see you again, stay safe. Bye-bye.